Okay, students, good evening to everyone. Let's just start another lecture, live revision class on consolidation. Today we'll be discussing further areas of, let's say, if disposal of shares in subsidiary plus further acquisition in subsidiary, and finally we will also discuss the step acquisition. Control to control scenario. The very important point is control to control scenario means your subsidiary will remain your subsidiary. Repeat. Control to control scenario means subsidiary remains subsidiary. When the subsidiary remains subsidiary, whatever the gain or loss comes, can I say that goes to other component of equity? Share purchase that have led to control over another company being obtained, share sale that have led to control over another company being lost. Look at this. Right now we are discussing if parent is having, for example, 80% holding. From 80, if it becomes 75. So obviously parent will remain parent, subsidiary will remain subsidiary. Whatever the gain or loss comes, that will go to other component of equity. Okay. For example, we did discuss this little bit yesterday also. For example, before selling the holding, let's say parent holding was 80% and NCI was at 20. If parent becomes at 75, then NCI becomes at 25. So main point is whatever the gain or loss comes, that goes to other component of equity. The NCI holding has decreased from 20 to 15. Okay, now this is another scenario. Now, instead of parents selling little bit holding and the subsidiary remains subsidiary, now the opposite case is, let's say parent was having 80% holding initially, NCI was having 20% holding. Now parent has acquired a further holding, but obviously even you acquire a further holding from 80, it becomes 85. NCI from 20, it becomes 15. But obviously the status is not changing. Your subsidiary is your subsidiary. But the difference is initially parent was having 80% holding, now 85. Again, whatever the gain or loss comes, even in this scenario. In case of further acquisition after getting the control, in case of further acquisition, after getting the control, whatever the gain or loss comes, that also goes to other component of equity. When a parent company increases its shareholding in a subsidiary, this is not treated as an acquisition in the group financial statement. For example, if the parent holds 80% of the shares in a subsidiary and buys 5% more, then the relationship remains one of the parent and subsidiary. However, NCI will decrease from 20 to 15. The accounting treatment of above situation is as follows. The NCI within equity decreases, and we should know that when NCI decreases, so you have to debit NCI. The difference between the consideration paid for the extra shares and decrease in NCI is accounted for within equity, normally in other component of equity. Note that no profit or loss arises on the purchase of additional shares. Goodwill is not recalculated. The following performer will help us. Cash paid, obviously credit. Decrease in NCI is debit. And before the calculating the decrease in NCI, you need to first calculate NCI at disposal. Logically, we are buying some of the holding from NCI. So you will not be able to directly calculate this decrease in NCI until unless you know that what is the amount of NCI at the time of, let's say, disposal, when NCI is selling some of its holding to the parent. So gain or loss, whatever it is, it goes to other component of equity. The decrease in NCI will represent the proportionate reduction in the carrying amount of non-controlling interest at the date of group additional purchases of shares. For example, if NCI shareholding reduces from 30 to 20, then carrying amount of NCA must be reduced by 1/3. Look at this. This will help us a lot. Calculate adjustment required to NCA and other component of equity. Gordon has owned 80% of Monday for many years. Gordon is considering acquiring more shares in Monday. The NCA of Monday currently has a carrying amount. So examiner is very nice towards us, I would say. So examiner has directly given us the carrying amount of NCA. Otherwise, in a long question, first you need to calculate NCA at disposal. With the net asset and goodwill having a carrying amount of 1,20,000 and 25,000 respectively, Gordon is considering the following two scenarios. Number one, Gordon could buy 20% of Monday shares, leaving no NCA. Obviously, if you buy the entire 20%, so there will be zero NCA. Look at this. Point number one, if I just explain with the help of double entry, debit and credit. Simply you need to debit NCA amount. The carrying amount of NCA is 20,000. So simply debit NCI, which is 20,000. Credit cash. How much cash we are paying? 25,000. Logically, there is a loss on further acquisition. There's a loss on further acquisition, and this loss and further acquisition is going to debit the other component of equity. So simply OCE, other component of equity, will be debited. Okay. Point number two, Gordon could buy 5% of Monday shares for 4,000, leaving NCI to 15. Before that, the value of NCI is, the percentage of NCI is 20. Parent, if buys additional 5%, so obviously NCI will left with 15%. No issue at all. Let's see. Second scenario. Debit and credit. You need to debit NCI. How to calculate the debit amount? The total carrying amount of NCI is 20,000. This 20,000 is actually representing the NCI holding of 20%. And NCI is selling 5% of that. This is logically the NCI at disposal divided by the total holding of NCI, multiply by the holding of NCI which they are selling it right now. So obviously we'll get 5,000. Cash paid is just 4,000. Logically, parent is having a gain of 1,000, but then gain also goes to other component of equity. So this is the scenario when parent gets further holding in subsidiary. Obviously, the status remains same. The parent will remain parent and the subsidiary will remain subsidiary. No doubt about it. Okay. Now, this is the scenario. I hope we did discuss this previously in the previous class. Sale of shares without losing control. Now, from 80, parent is coming to 75. Now, NCI will increase. In this case, NCI will increase. Parent is having 80% holding. NCI is having 20% holding. If parent from 80 becomes 75, so NCI from 20, it will become 25. Now, very important point is we are selling some of the, now parent is selling some of the holding to NCI. So number one, cash or bank, whatever, it will be debit. Increase in NCI will be credited. And how will you calculate increase in NCI? Increase in NCI can only be calculated if you know the net assets at the time of disposal. Whatever is the net asset at the time of disposal, let's say multiply by 5% if parent is selling 5% of the holding. So actually we need to know the net asset at disposal. Difference if difference is coming at the debit side, then it is loss on disposal, which goes to OCE. If the balancing figure is coming on credit side, then it is gain. Either there is a gain or loss. In both the cases, it is taken to OC, other component of equity. The accounting treatment of above situation is as follows. NCI within equity is increased. Now NCI is increasing. The difference between the proceed received and the increase in non-controlling interest is accounted within equity. Normally in OC. Okay. No profit or loss arises on the sale of the shares. Goodwill is not recalculated. Cash received, increase in NCI. But for calculating increase in NCI, we need to know net asset at the time of disposal. The increase in NCI will be the share of net asset. Look at this. The increase in NCI will be the share of net asset always. And goodwill fair value method only of the subsidiary at the date of disposal, which the parent has effectively sold to NCI. Okay. For example, if NCI shareholding increases from 20 to 30, then carrying amount of NCI must increase by 10%. Look at this. We have seen this yesterday also, if I'm not wrong. Until 30th September X7, Juno held 90% of Hera. On that date, it sold 10% interest in equity capital for 15,000. So consideration received is 15. At that date of disposal, the carrying amount of the net asset and the goodwill. So altogether, it is 1 lakh 20. We are selling 10% of this. So can I say NCI will increase by 12,000? Consideration received is debited by 15,000. Cash is received. Cash debit by 15. NCI will be credited by 12,000. So there is a gain, and that gain goes to other component of equity. The non-controlling interest should be increased by 12,000. The difference between the proceed received and the increase in non-controlling interest is 3,000, and this will be recognized as an increase to equity attributable to the owners of Jono. So obviously this 3,000 goes to other component of equity, number one. And second, entire 3,000 actually belongs to the shareholder of parent. Look at this. Discuss how the share sales should be accounted for in the consolidated statement of financial statement of the David Group. David Group, okay. David has owned 90% of Goliath, I believe, ordinary shares for many years. On the last day of the reporting period, David sold 5% of Goliath ordinary shares for 5,000. Means cash 5,000, debit. Holding from 90, it becomes 85. At the date of sale, net assets and the goodwill were carried in the consolidated financial statement for 70 and 20 respectively. The NCI of Goliath at acquisition was valued at fair value. It means full goodwill. So simply increase in NCI. How will you calculate increase in NCI? Total net asset including goodwill because of full goodwill method. In case of partial goodwill method, you will only consider net assets without goodwill. So you will consider goodwill in case of full goodwill method. So we have 70 plus 20, 90,000. 5% of that is 4,500. So there is a gain of, can I say 500? And that gain goes to OCE, other component of equity. So very important point is, student, look at this. When parent is having 90% holding and NCI is having 10% holding. Now, if parent wants to sell, for example, 20%, then from 90, parent will become at 70. NCI from 10, it will become 30. In that case, when you will be calculating increase in NCI, for calculating increase in NCI, you need to know the net asset at the date of disposal. If it is a full goodwill method, then you will add the goodwill into those net assets. Then multiply by 20% because NCI is increasing by 20%. In case of partial goodwill, you will only take the net asset without goodwill. But the opposite scenario is parent is having 80% holding, NCA is having 20% holding. Now from 80, if parent becomes 85, so from 20, NCA will become 15. Now there's a decrease in NCI. How will you calculate decrease in NCI? Before calculating decrease in NCI, first you need to calculate NCI at disposal. You need to calculate carrying amount of NCI at disposal. Whatever is the carrying amount of NCI at disposal, multiply by 5 because they are selling 5 out of 20. So these are two different calculations. When parent is selling some of the holding to the NCI, then NCI increases. When NCI increases, then you need to know the net assets at the time of disposal. In case of partial goodwill, only take net asset, multiply by, if you are selling 20%, multiply by 20%, you will get increase in NCI. If it is a full goodwill method, which is most likely to be the case, then net asset plus the goodwill at the time of disposal, when parent is selling some of the holding to NCI, multiply by the percentage by which NCI is increasing. But when we are buying some of the holding from NCI, then it is a different calculation. Number one, NCI will decrease. Logically, the NCI will decrease. It means you are calculating NCI will be debited by what amount. So first you need to calculate NCI at disposal and then rest is the holding. Okay. So these two scenarios, you should know the difference very well. Now, another important, I would say, aspect, subsidiaries acquired exclusively with a view to resale. If you have acquired a subsidiary with a exclusively with a view to resale, still you have to consolidate, but you need to look for IFRS 5 as well. A subsidiary acquired exclusively with a view to resale is not exempt from consolidation. However, if it meets the held for sale criteria in IFRS 5, non-current asset held for sale and discontinued operations, it is presented in the financial statement as a disposal group. Classified as held for sale, we know that all the disposal group assets, current as well as non-current, all disposal group assets, they are actually shown in SOFP under the current asset. Similarly, all the liabilities of discontinued operation disposal group, they are shown in current liabilities. This is achieved by amalgamating all assets into one line item and all liabilities into another. It is measured both on acquisition and subsequent reporting date at fair value less cost to sell. The held for sale criteria in IFRS 5 include the requirements that the subsidiary is available for immediate sale, means it is saleable in its present condition. The sale is highly probable, more than 50% chances that it's highly probable means your subsidiary will be sold within 12 months of after meeting the criteria. It is likely to be disposed of within 1 year of the date of its acquisition. A newly acquired subsidiary which meets these held for sale criteria automatically meets the criteria for being represented as discontinued operation. So if your subsidiary has met the criteria of non-current asset held for sale, then automatically it fulfills the criteria of discontinued operations because it is a separate line of business. Discuss how Jackie will be treated in the debit group. Financial statement on acquisition and on 30th September X7. David acquires Rose. On 1st March X7, Rose is a holding entity with two wholly owned subsidiaries, okay? Mickey and Jackie. Jackie is acquired exclusively with a view to resale. Meets the criteria for classification as held for sale. David's year end is 30th September. On 1st March X7, the following information is relevant. The identifiable liabilities of Jackie have a fair value of 40 million. When? 1st March X7, okay? on the date of acquisition. Liabilities are having fair value 40. The acquired asset of Jackie have fair value 180. Again, when? At the date of acquisition. The expected cost of selling Jackie are 5 million. On 30th September, the assets of Jackie have a fair value 170. From 180, now it has become 170. The liabilities have a fair value of 35. From 40, they have become 35. Selling cost remains same, which is 5 million. Okay. Now, what? Come here. If you are if you bought a subsidy exclusively with a view to resale, as soon as it meets IFRS 5 criteria, then automatically it becomes discontinued operations as well. How will you present it? That is very important. It is presented in the financial statement as a disposal group, classification as held for sale. This is achieved by amalgamating all assets into one line item and all liabilities into another. It is measured in acquisition and subsequently at fair value minus cost to sell. Fair value minus cost to sell. It means, look at this. On acquisition, the asset and liabilities of Jackie are measured at fair value minus cost to sell. At acquisition, we have fair value of assets 180 less cost to sell 5. I've deducted liabilities as well. So fair value minus cost to sell is 135. This is at acquisition. Now look at this on 30th September, the reporting date. At the reporting date, the asset and liabilities of Jackie are remeasured to update the fair value. Now assets are having a fair value 170. Selling cost is same. It is 165. Liabilities are 35. It is 130. Initially it was 135. Now it is 130. The fair value less cost to sell has decreased from 135 to 130. The 5 million reduction in the fair value must be presented in the consolidated statement of P&L as part of single line item entitled discontinued operations. Also included in line is the post-tax profit or loss earned incurred by Jackie in the March-September X7 period. The asset and liabilities of Jackie, how will you show this? Non-current assets held for sale 165. How did we get this 165? On reporting date. Jackie's liability will appear below the subtotal of the debit group current liabilities. Liabilities directly associated with the non-current asset held for sale is 35. No other disclosure is required. Look at this. Disposal of an associate. There's a possibility now that we are selling an associate. One possibility is 100% disposal of associate. Another possibility is your associate becomes your trade investment. When significant influence over an associate is lost, most likely as a result of share sale, then investment in associate is de-recognized and shares retained are likely to fall within the scope of IFRS 9 financial instrument. It will only happen when you have not sold the all holding in your associate. If you have not sold the entire holding, some of the holding is left, then the remaining holding, IFRS 9 will apply and should be recognized at fair value. Profit or loss on disposal will arise on the consolidated P&L and this is calculated as follows. You have to take the disposal proceed, add fair value of the retained interest, fair value of the remaining investment if you have. Carrying amount of the associate at disposal less. So you will be having a profit or loss. And that profit or loss will be, you have to show in the consolidated P&L. Discuss the accounting treatment of the above in the current year ended December X2. Raven purchased 25% ordinary shares of swords, ordinary shares. on January X1 for $1 million. Okay. So this $1 million is your cost of investment. This is cost of investment. We know that generally when you have holding from between 20 to 50, then that company is your associate. Okay, giving Raven significant influence over Sword, fine. On this date, Sword had retained earnings, so retained earning at acquisition is 3 million. On 30th June X2, Raven sold 20% of Sword's ordinary shares. So obviously, no more significant influence. Initially, you acquired 25%, now you have sold 20. So you're left with 5. Can I say on remaining 5%, you will apply IFRS 9? On 30th June X2, Raven sold 20% of Sword's ordinary shares, leaving it with 5% holding for 2 million. So the consideration received, the disposal proceed is 2 million. The balance on Sword's retained earning on this date was 3.8. At acquisition, it was 3 million and now it is 3.8 at the time of disposal. Sword has never had any other component of equity. Okay. A 5% holding in the ordinary shares on Sword was 0.5 million on 30th June X2. Can I say at the time of disposal, we need to know the fair value of remaining investment, which examiner has given us 0.5. Okay, now. Obviously, first of all, you just need to explain your examiner. The holding is reduces from 25 to 5%. It means after selling 20% holding, Raven will no more be having significant influence on Swords. Next point. For calculating gain or loss on disposal of subsidiary, first we need to apply equity method to calculate the carrying amount of associate. How do we calculate carrying amount of associate at the time of disposal? First, you have to take the cost of investment, add share in post reserves. Look at this. Let us first calculate investment in associates carrying amount. Investment in associate. Cost of investment is 1 million. Simply add shares in post reserves up to the date of disposal. Add share in post reserve up to the date of disposal. So at the time of disposal, retained earning we have 3.8. At acquisition, there were 3. The holding is 25. So can I say 3.8 minus 3 will give us 0.8 and 25% of 0.8 is 0.2. It means the investment in associate carrying amount is 1.2 at the time of disposal. Okay. Now simply, and we have sold this for 2 million. So definitely we are having a profit on disposal. Profit on disposal. And whatever the profit on disposal comes, or the loss on disposal comes, that will be recognized in the statement of P&L. Let's take the sale proceeds or consideration received, whatever you write, which is 2 million. Add fair value of remaining investment. Examiner has given us the fair value of remaining investment, that is 0.5 million. Fair value of remaining investment. Carrying amount of associate is 1.2. Carrying amount of associate. So there is a profit, can I say 1.3? Profit on disposal. So basically, we have received the cash 2 million. Fair value remaining investment is your financial asset. Fair value remaining investment is your financial asset. And on this financial asset, we have to apply IFRS 9. Either these shares will be classified as fair value through P&L, or by making an election, they will go to fair value through OCI. So cash debit by 2, financial asset debit by 0.5, investment in associate will be credited. Investment in associate credited by 1.2. So there's a profit on disposal 1.3. Profit on disposal. And this profit on disposal will be taken to P&L. Now, you have to explain examiner regarding the 0.5. Remaining investment, which is just 5%, IFRS 9 is applicable, number one. And number two, it depends on the classification of remaining investment. If the remaining investment is, let's say, organization has made an irrevocable election, and let's say it is the remaining investment is not held for trading, and organization has made an irrevocable election, then fair value through OCI is applicable. In case of fair value through OCI, whatever the change comes in fair value, that is recognized in other comprehensive income. And at the time of disposal, previously, whatever the gain or loss we have recognized, it will not be recycled to P&L. Another option is, if there is no irrevocable election, then obviously by default category is fair value through P&L. In case of fair value through P&L, obviously whatever the change in the fair value comes, that goes to P&L. Like here, you can see that. Where is the 0.6 million on December X2? So there's a increase in the fair value. 0.1 million, the fair value of your financial asset has increased. But what should be done with this 0.1? It actually depends on the classification. If let's say we have classified this in fair value through P&L category, then 0.1 goes to P&L. Otherwise, by making an irrevocable election, then the change of 0.1 million fair value will go to OCI, other component of equity. Now, let me share one more page. Just a minute. Step acquisition. Actually, step acquisition means acquisition of subsidiary in stages. Acquisition of subsidiary in stages. Because it is not necessary that in one go you have to get more than 50% holding. You can get this slowly and gradually. You can achieve this milestone of getting more than 50% holding. So what are the possibilities? Look at this. A step acquisition occurs when the parent company acquires control over the subsidiary in stages. This is achieved by buying blocks of shares at different times. Acquisition accounting is only applied at the date when the control is achieved. Any pre-existing equity interest is an equity in accordance with. There's a possibility it was IFRS 9. In case of financial instrument, before getting the control, you were having holding around 5, 10, 15%. There's a possibility it was your associate. So what are the possibilities? Financial asset becomes subsidiary. IS 28 means associate or joint venture. Another possibility is associate becomes subsidiary. IFRS 11, joint arrangement or other joint ventures. So your jointly controlled entity becomes your subsidiary. At the date when the equity interest is increased and control is achieved, what should be done? Remeasure the previously held equity interest to fair value. So whatever you have in your books, when further acquisition has given you the control, you have to remeasure the fair value of previous holding. recognize the resulting gain or loss in profit and loss for the year or in other comprehensive income if the shares had been designated to be measured at fair value through OCI. There's a possibility that your financial asset has become your trade investment, a normal investment becomes your subsidiary. And previously you have kept that trade investment in OCI category. In that case, when you will remeasure the fair value of your previous holding, whatever the fair value change comes, that goes to OCI. Otherwise, P&L. Calculate goodwill and non-controlling interest on either a partial goodwill method or full goodwill. Very important point is goodwill will only be calculated when you have achieved the control. For the purposes of goodwill calculation, the consideration will be the fair value of the previously held equity interest plus the fair value of the consideration transferred for the most recent purchases shares at the date of acquisition. Look at the performer. Fair value of previously held interest. So you need to know the fair value of the previous holding. Add fair value of the consideration for additional interest. NCI at acquisition. Fair value of net asset at acquisition, you will get goodwill at acquisition. And this goodwill calculation will only be carried out when you have got the control. This is important. Any gains and losses recognized in other comprehensive income from remeasurement of any previously held equity interest cannot be recycled to P&L. We know that. Previously, if there was a financial asset trade investment and you kept that in OCI category, then whatever the gain or loss comes, that will again go to OCI. Plus, important point is, you previously gain or loss cannot be recycled to P&L. Purchasing further shares in subsidiary, we have seen that after control has been acquired, for example, 60 to 70 is regarded as a transaction between equity holders. Goodwill is not recalculated in this situation. We have seen that. So student, this is your step acquisition. You should be really good in this area of step acquisition. Fair value of previously held interest. You need to know what is the fair value of previous holding at the date of control. And the important point is remeasure the previously held equity interest to fair value, recognize the resulting gain or loss in P&L for the year ended or in OCI if the shares had been designated to be measured at fair value through OCI. Then on remeasurement, whatever gain or loss comes, that goes to OCI. So students, we have discussed all the basics, plus we have discussed disposal areas, further acquisition, plus we have also discussed if parent is selling little bit holding and subsidiary remains subsidiary, what should be done. And we have discussed this step acquisition as well. Now we are left with only one, that is overseas subsidiary. Rules of overseas subsidiary, that's it. And after that, inshallah, we'll start properly practicing the questions. So only one area is left, but I don't want this video to be long. So inshallah, we'll discuss that area tomorrow. I'll share the timing. So tomorrow, inshallah, we'll cover the entire overseas subsidiaries issues. So thank you very much. And I strongly believe that you people are nowadays giving a lot of time to your revision. And please, I want everyone to give mock. Do attempt the mock. So thank you very much that you have taken time. Tomorrow, inshallah, we will cover the IS 21 area. Don't worry at all. So thank you very much. Have a nice life.